Ben.
Cheers.
Cool. Yeah, awesome to have you with us, Ben. So, as we know, Ben's just set up our Sidekick Selwyn office, and we've got the exciting things to talk about this week of tax. So, obviously, no one enjoys paying tax, but if you hurt yourself, you like going to hospital and being fixed. You like driving on the roads, and we like sending our kids to school. So it is a necessary evil of a civilized world. But look, there's been some recent changes to tax that I think it's really important that we do get a grasp of. But equally, you know, we don't expect our clients to understand tax like accountants do, like we do, okay? So there's some probably fundamentals that I think it's really worth discussing today. And of course, you know, we want to do this as well because with Ben being relatively new to our team and with us having a new office in Selwyn, you know, we're really keen to get the word out there to Selwyn because obviously we know there's a lot of businesses there that probably need a bit of help and are suffering a bit under this COVID situation. So, first things first, Ben. So one of the things that have just recently changed with tax is the change in provisional tax. So look, there's probably quite a bit of unknowns around provisional tax anyway, so we can probably cover that. But we, you know, in very simple terms, provisional tax, what is it, why do we pay it, and what's the new change in it?
Righto. So the IRD don't like waiting until the end of the year to get their cash.
Right.
Like small businesses, they like that cash flow. Most individuals pay their tax via PAYE throughout the year, but for a lot of businesses and a lot of sole traders, they don't do that. So the way prop tax works is we estimate what your tax bill is going to be at the end of the year. We use your prior year tax bill to do that, and then you pay your tax in installments throughout the year, so that there's no lumpy payment at the end of the year, and that just helps small businesses spread that burden throughout the year.
The flip side of that is as well, no one likes having that massive bill at the end of the year, you know. So that's surprising. Oh, by the way, your tax bill's $12,000 or whatever. It's a lot easier if you've already probably paid, you know, 7 or 8 or what.
Yeah, for sure. And so the changes that they made is that the prop tax threshold previously was only 2.5K, and that is being lifted up to 5K for the 2021 financial year. So that'll mean, I think the IRD said that there's around about 95,000 companies that'll benefit from that. And it just means that they can keep that cash in their business during the year and pay it at the end of the year. I think the reality is, though, a lot of small businesses will want to chip away at that rather than making that large payment at the end of the year. So it might not have too much of an impact, but the option is there to just delay that and keep the cash in the business.
Because the old principles still remain, don't they? That we don't use tax for cash flow. You know, you use your tax for cash flow. That's when we tend to find that you come unstuck come year end because where's the tax? We've spent it.
Yeah.
Can you explain to me though, when you say that threshold of 2.5K, where does the rubber hit the road on that? So how do we calculate whether it's 2.5K or 5K, and how do we pay it usually?
Righto. So what we ordinarily do is we look at your previous year's tax bill. If your terminal tax bill at the end of that year was less than 2.5K, you don't have to pay the prop tax. If your tax bill was more than the 2.5K, then you have to start paying provisional tax. I guess, like I said, that applies to a lot of small businesses, but the increase in that threshold will mean that a lot of businesses don't have to do that.
Cool. And that's per payment, is it 2.5K per payment?
No, so it's a 2.5K overall. So
what would your typical earning be then if that was your provisional tax?
So if you're a company, you're paying 28 cents in the dollar. So let's say you made a profit at the end of the year of 10K, you'd pay 2.8K of tax. So that gives you kind of a gauge as to what you're looking at there.
Yeah. And then if you had a couple of individuals in the business as well, with another, you know, at that rate, probably if they may have earned, say, 15 to 20K each, then they're part of that as well.
Yeah, it's going to capture a lot of shareholder salaries. Shareholders that take a shareholder salary at the end of the year. Ordinarily, if you're paying PAYE, you just pay that throughout the year. But a lot of businesses will declare that shareholder salary at the end of the year, which then results in those shareholders having to pay prop tax throughout the year.
Yeah, perfect. Monica, I understand you had a question as well for Ben.
Yeah, no. One of the other changes that's come about is the threshold for writing off assets for depreciation. I guess we're, as accountants, we're familiar with depreciation, but I was wondering if you could speak a little bit to the purpose of depreciation and what these new changes mean.
Righto. So depreciation applies to assets. So ordinarily when you're making purchases in your business, it's expected that those expenses kind of only last a short period of time. For assets, so if you think of something like a desk, ordinarily you're going to get the benefit of using this desk over a number of years. Therefore, writing it off as an expense in 1 year doesn't quite fit right. So what we do is we estimate how long you're going to get a useful life out of that asset, and then we'll recognise that cost that you might ordinarily expense in 1 year over several years via depreciation. Two ways of doing it. The common one's a straight line, where you just recognise a single amount each year until you use the full value of that asset, or diminishing value, where we recognise that you get the most benefit out of it in the early years, and then as those years go by, the assets degrade, you don't get as much use out of them, and they lose their value. So I think for small businesses, the most common one we see is the diminishing value.
It's like if you buy a laptop, isn't it? You know, laptop's probably going to last you 3-4 years of a useful life, so but you lose all of its value in the first year, don't you really?
Yep,
so,
exactly right.
And then half of that,
And so ordinarily in the past, the threshold for capitalising those costs as an asset was $500 per asset, or if you're buying a large group of assets, then you stack them all together. That $500 threshold has been increased to $5,000 for the 2021 financial year, which means that if you're purchasing assets up to the value of 5K, you can expense them now in this financial year without having to recognise that cost as depreciation in future years. Therefore, that's going to reduce your net profit and then ultimately reduce your tax bill at the end of the year.
Yeah. What does that do? We're probably going to get a little bit technical here, but what does that then do for almost like your financial reporting with the or with the bank? Because you're still going to have an asset schedule in your business.
Yep.
Still going to have a value. Let's say, you know, well, the most fun way of spending $4,999 is probably some kind of motorbike. Right, so I go buy this motorbike, ride it around, have fun, fall off, decide I need to sell it. But let's say that's worth $3,000 when I come to sell it.
Yep.
What's going to happen to me then if I've expensed it all?
Yeah, I think that's going to be really interesting. And to be honest, we haven't had any situations like that just yet. But ordinarily, if you've expensed it, you've already recognised the cost for it. If you go to sell it, because it hasn't gone through your balance sheet, I'd suggest that it's probably just going to be revenue, a normal case of revenue. But I'd like to see some more guidance come out from that. Yeah.
There's going to be loads of unknowns around that.
I think just in general over the past several weeks, there's been a lot that's come out. They've had to pump it out in a pretty quick period of time. And then they're now backtracking and kind of thinking about those things and what they mean.
Yeah. Because there's always been a really common misconception, and I suppose I'm speaking to the audience here, that I'm going to have a tax bill coming up this year, so I better go and buy some big expensive stuff to reduce my tax bill. And historically, you go spend 20 grand on your trailer, you go spend 10 grand or whatever on a new ute, but then you still get whacked with this tax bill because basically all you've done is spend a bit of money on some assets that actually you've still got the value of it. So I've seen and heard of many people that have really got themselves unstuck here because they just thought, oh, I went and spent some money, I shouldn't have tax to pay. But no, you've now got tax and no cash because you spent it on the thing that you didn't need to buy.
Yeah, I guess you've just got to be careful what you buy. Like things like motor vehicles, they do have a short useful life, so you do get to claim that depreciation back pretty quickly over 3 or 4 years. I'd suggest if you are looking at buying assets under $5,000 at the moment, this year's a really good year to do it because you do get that benefit up front. So I wouldn't be surprised if we do see a lot of companies out there spending that money, and I guess that's what the government want to see. They want to see that money being spent. There's that incentive for small businesses to go and do it.
Yeah, perfect. All right, great. And Mordecai, I think you'd had another question as well, hadn't you, for Ben?
Yeah, no. One of the other things that's come into effect is the loss carryback rule.
Sure.
Care to elaborate a little bit on that?
Cool. So yeah, we've got a temporary loss carryback at the moment, and they're thinking about extending it to permanent, but we haven't seen much about that yet. Ordinarily, if your business makes a profit in a year, if it makes a loss in a year, generally you can only carry forward those losses to offset future profits. What they've done with this tax loss carryback scheme is if you make a loss in the 2020 financial year, you're able to carry that back to offset any profits in the 2019 financial year. So let's say you made a loss of 100K in 2020, but you made a profit in 2019 of 100K. If you're a company, you would have paid 28 cents on the dollar, so you would have paid about $28,000 worth of tax. Now, because you can carry back that 100K to offset that 100K profit, you've got a net profit of nil, you've got a tax bill of nil, but you've paid 28K in tax, so you get that cash back. Similarly, for the 2021 financial year, at the moment we're able to estimate what we think those losses might be, if there are going to be losses, and use that to offset any profits from the 2020 financial year. Few risks around that in terms of getting it right, and I suggest kind of delay that till later in the year to try and make those kind of estimations. Because if we get it wrong, we'll be looking at things like use of money interest. A couple of other things just to be aware of is the shareholder continuity rules. So you need to, I think, for it's just a company, you need 49% shareholder continuity. If it's a group, I think it's about 66%. The other thing you need to be aware of is if you've paid a dividend out during the year to get rid of some of those profits that you had in previous years, some of the imputation credits attached to that tax that you paid would have been paid out as part of those dividends. So you just need to make sure that if you have paid a dividend, there's enough imputation credits sitting there for you to carry that loss back. So to get the cash back from the profit.
So if your business was adversely affected by COVID over towards the end of the 2020 financial year, it might be worth trying to see if you can carry back any.
Yeah, 100%. If you're, I'd strongly recommend any kind of clients or talking to your tax agent just to understand where you might be. I mean, we'll be processing in your accounts throughout the year, but if you think you've got a loss, please do get in touch. We can look at that urgently and see if we can get you some cash back.
And when you were just talking in a bit of a foreign language there for the people watching, and honestly, like this is second nature to you. And I know I just went through an exercise where bought shares in a business, and therefore one of the shareholders was leaving, and I got this thing to sign, and it looked like I was getting money, and I was like, oh, this is great. So this is like tax back. We made a loss, blah, blah, blah. And then I signed it and handed it to Cam, and I was like, does this mean that I get some money? No, they're imputation credits. But what are they? You know, like it's it's really tricky to know. This is where I would say, go speak to your professional tax advisors on this stuff, because it's going to be a really sad day if it turns out you've gone and sold, a partner thought, oh, this is too tough, I'm selling out, I'm out. And you go, yeah, that's fine. You buy the business for $1 or whatever it might be, or $100,000. You buy it, you're now the sole shareholder. You go and try and take use of this because cash flow is really tight. Well, actually, you can't do it because you don't have that continuity or that consistency in the shareholding that's required. And so you're basically giving away those losses, aren't you? Or that access to that loss right now. Yeah. But I am, only because I've been on the wrong side of getting that information and not knowing it. So, but again, it just ties back to having conversations, and don't make those rash decisions. They are pretty much never rewarded, are they, in business?
Yeah, I mean, please get in contact before you do things like that. Often we hear, about those things halfway through the process or maybe towards the end. So much better to know in advance that we can advise you properly before you make perhaps a mistake.
Yeah, absolutely.
No, thank you so much for joining us, Ben. Hopefully that didn't get too technical.
I got a bit carried away.
It got exciting in the middle there, talking about imputation credits.
Time flies when you're talking accounting and tax. But yeah, if you're picking up what Ben is putting down, as always, feel free to get in touch and drop him some questions in the comments. And later on, actually, we'll be putting up a poll to see what sort of industry interviews you'd like us to do going forward. So keep an eye out for that. But see you next week, same time, same place.
Oh, I'm just trying to hang up over here.
We need